In today's episode, I will talk about three very interesting stories. In the first story, I'll talk about how Byjus has officially gone down to zero now as per its founder Byju Ravindra. In the second story of the day, I'll talk about RBI's new action on Navi FinServ and some other NBFCs, and also we'll talk about what it means for the entire NBFC sector of India. And in the third and final story of the day, I'll talk about how rubber prices are changing and tire manufacturers are feeling the heat. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news in the financial markets in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 21st of October. By the way, the Daily Brief Show is now also available in Hindi, so do check it out from the link in the description below if Hindi is your preferred language. Also, if you like reading instead of watching or listening, you can also sign up for our no spam newsletter for a very quick rundown every single morning. All the links, by the way, are in the description given below. Let's start with the first story. On October 17th, 2024, Byju Ravindran, who's the founder of Byjus, revealed that the company, which was once valued at a staggering 22 billion US dollars, is now worth nothing. Byjus, which was once seen as the crown jewel of India's booming edtech sector, has now come crashing down. Now, this dramatic fall has left everybody asking, what exactly happened? So let me walk you through this story of Byjus today, its meteoric rise, and a series of events that led to its downfall. For everyone unfamiliar with Byjus, though that's not a likely scenario, Byjus was an educational technology company that initially took off by offering online learning solutions primarily for school students. By combining engaging videos, interactive lessons, and a mobile app, Byjus brought learning to children in a fresh, exciting way. At its peak, Byjus was once the most valued startups in the world, especially in the education sector. But behind all of the success, several critical issues were brewing behind the scenes, which ultimately led to their collapse. The start of Byju's rapid growth was fueled by two key factors: aggressive acquisitions and a massive injection of cash from high-profile investors. See, between 2019 and 2021, the company went on a buying spree. They acquired over 24 companies. Two of the more noticeable purchases by Byjus were White Hat Junior, which was a coding platform for children which was acquired for 300 million US dollars, and Akash Educational Services, which is a well-known offline test preparation company which Byjus bought for nearly 1 billion US dollars. Now, these acquisitions seemed more like smart moves at that time. Byjus aimed to expand its product offerings and reach more and more students across different learning areas. Now, White Hat Junior opened doors to the booming coding education market, while Akash, on the other hand, gave Byjus a very strong foothold in the traditional exam preparation space. But integrating these companies into the Byju's ecosystem turned out to be much more challenging than Byju's had ever expected. Managing the operations of so many businesses under one umbrella proved to be very difficult, and the acquired companies started to struggle to turn profitable. And this put a huge strain on Byju's cash flow. Now, Byju's aggressive growth came at a very heavy cost. The company was burning through cash at an unsustainable rate. Investors such as the Chan Zuckerberg Initiative and Tiger Global had poured billions of dollars into Byju's, but the company spent this money as quickly as it almost arrived to them. Byjus operated on a strategy that relied on continuous growth and the assumption that it could always raise more and more money whenever they wanted to. Now, this for sure worked for a while for them, especially during the pandemic when online education was in very high demand. But the moment the pandemic subsided and the market conditions changed, this approach backfired. The company found itself in serious financial trouble. As the pandemic subsided and schools started reopening, the demand for online education started to decline very rapidly. At the same time, the flow of funding also began to dry up. So Byjus found itself in a liquidity crisis, which in simple terms means that it was running out of money in order to keep its operations going. Complicating matters even further, there were legal issues in the United States. In September 2024, a Delaware court placed several of Byjus' US subsidiaries into involuntary Chapter 11 bankruptcy. Now, this occurred after Byjus failed to provide necessary financial information to its creditors. Now, the Byju's management called this very surprising, and it created a conflict between the legal proceedings in the US and in India, where Byju's was also undergoing insolvency proceedings. Now, the legal landscape has now become super complex as Byju's has struggled to deal with bankruptcy laws in two different jurisdictions. But at the core of these legal issues were allegations of financial mismanagement. One major point of contention was the unauthorized transfer of 700,000 US dollars between Byjus and US subsidiaries, which allegedly violated US bankruptcy laws. Now, the problem was that this transfer was made without any proper authority, which raised suspicions of fraudulent activity. And it doesn't even end here. Byjus was also accused of concealing 533 million US dollars in cash that had been moved out of the US, leading to contempt charges against Riju Ravindran, who's a board member and a brother of the company's founder. To make things even worse after that, Byju's legal troubles extended to its own defense. Two US law firms who represented the company sought to withdraw from the case. They cited an irreparable breakdown in their relationship with Byju's. They claimed that the company was not cooperating in its defense against creditors pursuing claims related to the missing funds. Now, this lack of cooperation reflected deeper internal problems with Byju's, which included governance issues that were already causing some concern. But that said, Byju's was not just facing legal and financial problems, there were also some very serious issues with the company's products. The company faced growing criticism for selling overpriced and often subpar educational packages. Parents who had bought into Byju's promises of high quality education soon started to feel very disappointed in them. Many parents also started to complain about the very aggressive strategies that Byju's was using in order to pressurize them into purchasing expensive packages that did not quite provide the value that they were promised. Basically, in a rush to launch new products and maintain its revenue, Byju's sort of lost sight of its core focus, which was offering quality education. The company's attempts to diversify too quickly led to a loss of focus, and the quality of its core offerings began to suffer. This growing dissatisfaction among customers only further damaged Byju's reputation. Also, the company's governance issues were another major contributors to its big downfall. In 2023, key investors including Process Ventures and Deloitte resigned from Byju's board of directors, and they cited concerns over how the company was being run. Byju's lack of financial transparency made investors very nervous, and as trust eroded, it also became increasingly difficult for the companies to raise additional funds that they required in order to run the business. The financial problems of Byju's only deepened in early 2024 when they attempted to raise 200 million US dollars through a rights issue. But the pre-money valuation in this case had dropped to just 20 million US dollars, which was a shocking 99% fall from the previous valuation of 22 billion US dollars. Investors were very reluctant to participate in this funding round, and the company's equity was even further diluted. Apart from that, the company's aggressive expansion strategy also led to a lot of chaos within its own ranks. Over the last 2 years alone, Byju's has laid off thousands of employees in an effort to cut costs as well as manage rising expenses. These layoffs are a sign that Byju's had failed to properly integrate its acquisition or streamline its operations properly. Byju's had initially thrived during the COVID-19 pandemic when students were transitioning to online learning methods. But once schools started reopening and the demand for online education started to decline, the company struggled really badly in order to maintain the same level of engagement. Its business model, which had grown too reliant on rapid expansion, could just not adjust to the post-pandemic reality of the world. Byju's had also planned to go public through an IPO in 2021. They were aiming for a valuation as high as 50 billion US dollars. But due to unfavorable market conditions, the IPO was delayed, which left Byju's without the funds it needed to stabilize its finances. So for all of us, the Byju story serves as a reminder that even the brightest stars can fall if they lose sight of their own basics: sustainable growth, good governance, and a strong focus on delivering real value to consumers. Let's now move on to the second story of the day. The Reserve Bank of India recently barred Navi Finserv, which is a company owned by Sachin Bansal and 3 other financial institutions, from issuing new loans. Now, this ban will come into effect on October 21st, 2024, and everyone is now talking about how this could change how NBFCs do business in India. But the question is, what exactly happened and why did it happen? Let me break it down for you in very simple words. See, these companies, which include Navi FinServ, were found to be charging borrowers extremely high interest rates and not following RBI's guidelines on something called the fair pricing. Now, the question is, what is fair pricing? See, very simply put, when a company lends money, the interest rates and the fees that they charge should be reasonable, transparent, and in line with the regulatory standards. RBI's goal here is to make sure that people taking loans are not being exploited with hidden fees or outrageously high interest rates. So in order to push that, RBI introduced stricter rules around this back in 2022, where they focused on digital lending platforms like fintech companies, which are known for offering fast loans online. Now, this was done because there were growing concerns that some companies were taking advantage of people by charging them too much money. Navi FinServ, for example, has been growing very rapidly, and most of their business comes from unsecured loans. In fact, about 90% of the loans that they offered are personal loans, which are loans where people do not really need to offer anything as collateral, and this makes them very risky as lenders. And because Navi offers so many personal loans, its revenue now very largely depends on its large loan book, which is almost worth 12,000 crore Indian rupees. So with this new ban in place, Navi FinServ cannot issue new loans for the time being, which is a bit of a setback for the company because, as I said, loans are its primary source of income. But to make matters even worse for them, even though they recently appointed a former RBI executive director, Anil Kumar Mishra, in order to improve their compliances, this latest action by RBI shows that Navi still has a lot of things to fix. Also, this RBI decision is not just a one-off case. Over the past few years, the RBI has been tightening its grip on financial institutions, particularly targeting non-banking financial companies or NBFCs, fintechs, and digital lenders. In December 2020, the RBI had barred HDFC from issuing new credit cards and launching new digital products. This is after HDFC experienced repeated IT outages which disrupted customer services. HDFC had to fix its systems before the ban was fully lifted in March 2022. Now, in March 2023, Axis Bank was fined 1.91 crore rupees for failing to comply with regulations, which included improper KYC management and loan handling. In November 2023 as well, Bajaj Finance was stopped from offering products like Insta EMI due to violations of digital lending guidelines. Now, these restrictions were lifted this year after Bajaj resolved their issues. In February 2024, the RBI took action against Paytm Payments Bank by stopping them from onboarding new consumers or accepting new deposits. This again was because of issues with KYC compliance and cybersecurity protocols. Closer to the day, in August 2024, the RBI has introduced new guidelines to tighten regulations on peer-to-peer lending platforms. Peer-to-peer platforms, by the way, connect individual borrowers directly to lenders, and they offer an alternative to traditional bank loans. These platforms became very popular because they offered lenders higher returns and also provided loans to borrowers who might not really qualify for bank credit. But problems started to creep up as platforms often failed to screen borrowers properly, and some even misled lenders with the promises of guaranteed returns. The RBI stepped in to address these concerns, and they implemented rules which banned credit guarantees and required lenders to approve every single loan individually. The RBI ensured that funds were transferred to borrowers within T+1 or else returned. Additionally, P2P platforms could no longer market themselves as investment products. Now, this crackdown is also in line with growing concerns across the financial sector about the risk tied to unsecured lending. Take Axis Bank, for example. Even though they reported an 18% increase in profits in their recent earnings call, they admitted that defaults on their unsecured loans like personal loans and credit card debt are rising now. While Axis Bank is managing the situation for now, they are unsure when things will improve for them. So all in all, the RBI's move right now is not just about Navi FinServ specifically, but it's part of a broader effort in order to protect the financial system and to ensure that borrowers are not taken advantage of by unfair lending practices. The RBI is clearly watching unsecured loans very closely, and we might see more actions in the future in order to manage risks and keep lenders in check. In the next story, let's talk about an issue which is making Indian tire companies worried: the soaring price of natural rubber. Look, rubber prices are at their highest in 13 years now, and it is a situation which is starting to hurt the Indian tire industry. But before I jump into how this exactly impacts Indian tire makers, let me break down what is exactly happening here. See, to put it very simply, the price of natural rubber, which is a key material used in order to make tires, has shot up significantly. Back in 2011, rubber prices had crossed 200 rupees per kg, which was largely due to the effects of global financial crisis. The governments and central banks around the world were pumping money into their economies in order to boost growth, and this pushed the demand for many raw materials, including that of rubber. But after 2011, the situation calmed down a little bit. For about a decade or so after that, prices remained very steady and they hovered around 150 rupees per kg on an average. But in 2023, rubber prices started to surge once again. They crossed 200 rupees per kg, and this time it looks like it is not just a temporary spike. There is also a deeper problem, which is a persistent mismatch between supply and demand in the rubber market. So the question is, why is this happening? See, the demand for rubber has outgrown supply recently. According to a CRISIL report, between 2011 and 2023, rubber production increased by about 35%, which may sound like a decent rise, but the catch is that during the exact same period, demand jumped by 40%. Now, the gap between how much rubber the world needs and how much is being produced is getting wider by the day, and it is starting to create a strain in the market, which is making it very hard for prices to come down. So therefore, the next question is, how did the gap come about? See, to understand that, we'll have to go back to 2011 when Southeast Asian countries like Thailand, Indonesia, Vietnam, as well as Malaysia were leading the world in rubber production. See, these countries alone accounted for about 80% of global rubber supply. And at that time, high prices of rubber motivated farmers to grow more of it, which led to an oversupply. Even India ramped up its production with rubber output peaking in 2013 at that time. But things started to change immediately after that. Rubber prices started to stagnate, meaning they stayed flat for a long period of time, and this made rubber farming less attractive over time. As a result of it, farmers started to shift to other crops which were much more profitable, and the total area of land being used for rubber farming did not quite increase after the year 2015. Even worse, a lot of rubber trees got old, and old trees do not quite produce as much latex, which further slows down production of rubber. Now, that said, while rubber production was slowing down, the demand was in an exactly opposite trajectory. With central banks continuing to ease their monetary policies, the global economy kept growing, and so did the demand for rubber. The problem here is that rubber trees take 6 to 8 years in order to mature. So even if more trees are planted now, they won't quite start producing rubber immediately. And this means supply cannot catch up as fast as demand can. And that is why we're seeing only a 1 to 2% rise in supply versus a 3 to 4% rise in demand today. This growing gap could lead to a more serious shortage in 2024, 2025, and so on. Now, with that context in place, let's come back and talk about the tire industry in specific, which is feeling the pressure right now. See, tires are made from a mix of materials like natural rubber, synthetic rubber, carbon black, steel, and textile cords. But natural rubber out of all of this is one of the most crucial ingredients, and it forms a very big part of the overall cost in producing a tire. But it gets tricky here. India does not quite produce enough rubber in order to meet our tire industry demands. In 2023-2024, India's rubber production stood at about 8.6 lakh tons, but the demand, to give you a comparison, was much higher at about 14 lakh crores. So this creates a huge gap which has to be filled with imports. But the problem is, importing rubber is not at all cheap. India imposes a 25% custom duty or 30 rupees per kg, whichever is higher, on imported rubber. But interestingly, even with this custom duty in place, importing rubber is still often cheaper than buying it locally. This is because global rubber prices are generally much lower as compared to India's domestic prices. But the thing is, while this helps tire makers in the short term, it is not quite a sustainable solution. Why, you might wonder? Look, cheaper exports make it less attractive for local farmers in order to grow rubber. If farmers do not find it profitable, they will just not plant more rubber trees, and India will remain dependent on costly imports. So then the question is there something being done to fix this? And if yes, what? Look, tire companies are pushing the government to reduce the custom duty on rubber imports. But so far, the government has not quite agreed to this. They want to focus on increasing rubber production in order to reduce reliance on imports altogether in the long run. And in order to address the supply issues, the Rubber Board of India, the Automotive Tire Manufacturers Association, and the government have together launched a project to expand rubber cultivation in the northeastern states of the country. Currently, most of the rubber production in India comes from Kerala and Tamil Nadu, which covers about 5 lakh hectares. The hope is that growing rubber in the northeastern states of India can increase domestic production and also meet the rising demand. But in the meantime, tire companies are struggling quite a bit. Take Seat for example. In their latest earnings report, they mentioned that rising commodity prices, especially rubber, are cutting into their profit margins. While importing rubber has temporarily eased the pressure on them, this is only a short-term fix. So if tire makers do not find sustainable ways to manage high rubber costs, they could seriously face some longer-term challenges to their profitability. So all in all, to conclude, the natural rubber market is currently caught in a bit of a tricky situation. Supply cannot keep up with demand, and while companies can rely on imports for now, it is definitely not a sustainable solution going forward. The key will definitely be in increasing local production, but that is easier said than done given the long time that it takes for rubber trees in order to mature and start yielding results. This means tire companies will need to carefully manage their costs and also advocate for policies that encourage sustainable growth in India's rubber industry. If that does not happen, these companies might be stuck in paying higher prices for a key raw material, which could eventually squeeze their margins for many years to come. Now let's move on to the final section of the day, which is the news tidbits. First, inflows into gold ETFs have surged by 88% in 2024 and they have reached about 1200 crores. This was driven by rising gold prices and a preference for ETFs over physical golds due to concerns around storage and liquidity. Anticipated US Fed rate cuts further increased the demand for it. Second, Adani Enterprises raised 4,200 crore rupees through a qualified institutional placement or QIP. This offering saw strong demands with bids 4.2 times the deal size. The fund will be used to support growth in infrastructure and energy sectors. Third, the Karnataka government plans to introduce a 1 to 2% transaction fee on platforms like Swiggy and Zomato. This fee is intended to fund gig worker welfare and social security measures for delivery workers. This, of course, may slightly increase costs for consumers like you and me. Fourth, the Coastal Shipping Bill 2024 removes the requirement for Indian flagged vessels to obtain trading licenses for coastal operations. This aims to boost domestic shipping and reduce costs. But industry leaders are calling for additional tax relief in order to ensure sustained growth. That's all the news and stories I have for you today. I hope you found this episode valuable. I'll see you tomorrow. This is Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.